Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul look back on their second year of podcasting. In the beginning, they focused on the process, recording one conversation at a time, and eventually, they established a consistent habit. To wrap up Season 2, our hosts recount their favorite episodes of the year. So which ones did you enjoy the most? Listen to the end to find out. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So this is our second anniversary episode. We have now been doing this episode every week for the last 104 weeks. And we are, just like we did a year ago, we're going to take some time to kind of look back over our second year. So one, I think I mentioned this very briefly when Trishul reminded me that a few episodes ago, it was episode 100, that when we started, we honestly didn't know if we would get this far. Like it was very possible. That was our initial plan, but we started recording a few episodes. See, do we like talking to each other? Can we stand each other for an hour at a time each week? And I remember mentioning that Trishul was very optimistic that he labeled it EP001. It's like, okay, I guess we'll try and get to triple digits. And now we're here. We're 2 years in, and this is our 104th episode, and it's a little surreal. I don't know what to think about how well you and I have sustained, but maybe that's kind of the point. It's like, and that's one of the messages that we've kind of passed on in many episodes, is just start a little bit at a time. You just do the first episode, then the second, and then the third. You just record a few, then you figure some things out. You figure out some podcasting, hosting, and by figuring that out, I mean Trishul's done vast majority of the work in that end. And you just kind of keep going. And then 2 years later, you look up and you've recorded 103, and now on your 104th episode, and you're 2 years in. And I kind of like that. I kind of like that we have a specific example of you and I following the process that we've talked about, and we can kind of show, yes, it takes 2 years, and it's hard in 2019 to be looking like, oh my gosh, what are we going to do in 2 years from now? But anything that you want to do, you just have to start doing that little bit and then keep adding on to it. So before we get into our favorite episodes from our second year, Trishul, do you want to share kind of your initial retrospective of kind of how we got to 2 years, how the podcast is done, some of the changes we've made, some of the changes you have made, kind of you've really been driving that. But when you think we've done this, this is our 104th episode and we're 2 years in, what first came to mind for you?
I just, remember that initial conversation where you told me, the average podcast lasts 8 episodes. So, let's aim for 9.
I don't remember where that stat came from, but I like that.
And, when we were starting, we really didn't think that much ahead. I think that's also part of it. Just try to stick to the intermediate goals and the short-term goals and let the future kind of take care of itself. I think that was a good part of it. And yeah, when we really started recording those initial episodes, we had no clue what was going to happen. I think it was just, let's meet at this time, let's record for an hour. And then, when that was done, we said, okay, let's meet next week. And then after a month or two, we had all these recordings and no idea what to do with them. And it certainly has evolved since then. We've come up with the processes, the ways to distribute and the ways to edit and all of that. And frankly, it's gotten a lot of easier as well. It's one of those things where you just keep doing the same thing and you end up figuring out where the fat is and making things slim and mean and efficient. And frankly, the production isn't that big of a deal now. We've found some nice tools that help. We're using Zencaster, which is this nifty tool where it records Aaron's voice and my voice separately, locally, and then we ship them across these big files across the internet once the conversation is done, and then we stitch them together. It's better than our previous early episodes where we recorded them over like Zoom, and the quality kind of suffered, I think, because of that. But I think we've come a long way, and hopefully that shows in the production quality. Maybe that is a little better. I think it helps that it's not like a fuzzy recording over the internet that we're kind of putting out there. But also, to actually get the episodes out, it has become a little bit easier. But, frankly, we have also become a little bit more busy with our actual businesses. So I think that's our listeners may have noticed that episodes don't quite make it out there on a weekly basis. We do end up having to catch up every now and then. And it's also because this is something where we do have other things going on in the background, particularly the businesses that we're trying to run.
Yeah, I think that's been so I still, again, 2 years in, I haven't quite grasped, is this podcast helping our businesses? Because I think it is. I know a couple clients have mentioned they listen to episodes, and I think they like getting our kind of long form thoughts and conversation on some specific topics. But I don't know that it has truly helped my business grow. It might in a way I don't know, but it's kind of like when we first started, like, okay, this is one of our forms of marketing for our business. And I don't know if it's actually helped my business, but I still enjoy the process. And so as more clients have come on and I've had to be more intentional about scheduling my time, this has still been one of the things I wanted to keep in there, that I've enjoyed our conversations. And so I'm curious. I don't know if the podcast succeeded or has succeeded in the way we intended 2 years ago. Because I think when I first started, I think it definitely was thinking in terms of a form of marketing. And basically, I liked our conversations just a little bit more than I liked writing. So I don't know if it succeeded from that perspective, but I don't regret. I don't consider it a failure either, if that makes sense.
Yeah, that makes sense. I think, frankly, when I went into this, I remember coming across some reviews or research that suggested that you may not get too much out of it that's visible in the first 2 years. So in my mind, I set the bar really low, thinking, okay, let's just do this for 2 years and then maybe think about evaluating. And now we're 2 years in, but this would be the time to maybe start thinking about, is it adding value or not? But thing one, I agree with what you say. I happen to enjoy the conversations we have. I've mentioned this before. It feels like this ability to, kind of vent about the things that you want to really get into that you don't really have the time to in a normal interaction with a client, just because it's great to dig an hour into a topic, but sometimes that might be a little too much for a day-to-day conversation. However, being able to still reference that with clients, I think does provide value. Meaning, if there is a situation where I can point back to the podcast and say, "Hey, we did discuss this, and there's tons of background information that you may find helpful you're welcome to check it out. I think that has been useful over this time. And at the same time, I think the podcast is getting out there. The amount of listens and downloads that we get has grown quite a bit from the first year to this year. So I think whatever is building is continuing to build, which is certainly a good thing.
Do you have some of the numbers for us?
Yeah, I do have some numbers. So where should we start? We're at a top line. We have almost 6,000 episodes ish. We'll probably cross that in the next by the time this releases.
6,000 downloads.
Oh, downloads, yeah, not episodes. We know we have about 100 or so episodes. This is 104. And here's our top 5 in terms of listens. The very first episode, top left episode. I don't know if you can guess this, Aaron. Do you have any guess?
I
don't know if you peeked, but
I have not. I want to say I'm gonna guess it's like 15% of our total downloads. So I'm gonna guess like 1,000.
Our top episode.
Yeah, because it's like 1,000 of our 6,000.
No, the top episode is 212.
Okay. 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 That made I had no scale for that.
Any thoughts on what it could be? Which is the top?
Oh, isn't our? I thought you said it's our first episode.
Oh no, it's not. It's not.
Oh really? Oh, okay. I have. Okay. I'll wait. Okay. I know. Last time, like 6 months ago, it was definitely our first episode. Then it was Aaron and Trishul Get Personal. I think it was episode number 4 would have been one of them. Is it like the Bitcoin one or the crypto one?
You got it. Yeah.
Okay, so man, that it's one of those, like, I don't want that to be our best episode, but it's just so popular online right now that that's the most one that like people seek out, kind of thing.
Yeah, and so it's episode 97. It's called "Blockchain is Here to Stay, but How Much Crypto is Too Much." And I'm not so unhappy that it made it to the top, mainly because it gives us, or at least it gave me, the opportunity to put forward my best thinking on an issue that frankly does come up quite a bit. It's come up in many conversations that I feel it's warranted to at least have my opinion out there.
That's a good point. And I find myself, I keep coming back to being less and less skeptical, but still not an active pursuant of anything related to crypto. But it's definitely like, yeah, I need to make sure I understand it well enough, because like you said, people are going to keep asking those questions.
Yeah, and I think it also suffices to say that the opinion that I put out, and I think you share this similar opinion, it's not exactly in line with what you probably hear when it comes to crypto. It's a little contrarian from that perspective. So I think having an opinion that's not quite mainstream when it comes to something like this is also helpful to add a little counterbalance to what people normally hear.
Yeah. So how many downloads does that episode have?
Yeah, so it has 212 downloads. It's the number 1, and it beats the next one by a good 50.
Wow. That must have been all. That was actually that's just in the last month or 2. Yeah. So we're at 104. So that's 2 months ago, and wow, that
So,
is like it got that many that fast, because I know the first one was just kind of always slowly building up, always kind of staying on top. That's also pretty impressive.
Yeah, so there's a little secular change going on as well. So our actual listenership has increased. So I think that gives the more recent episodes a boost over the earlier ones.
I see. That makes sense.
Yeah, so the ones that are kind of at the top of the stack tend to get a little more face time than the ones towards the middle and bottom.
Okay. Any other interesting numbers that stood out to you?
Well, I'll just quickly mention, as a notable mention, here's the top five. So 97 is the first, and that's the blockchain one. The next one is number 33. The If you have incentive stock options, you need to listen to this episode.
Oh, okay. I'm actually that one I'm genuinely happy is high on the list.
Yeah, that's always been a favorite. I think it was up there last year as well. Number 3 is number 92. When it comes to tracking performance, here's what really matters. And that was a good vending session for myself personally, so I like that. Number 4 is our first episode. What's the big deal about fire? That's always been a favorite from the first year, so that's still up there. And number 67, you might not realize it, but this actually had a pretty good start earlier this year. It's if you're in this unlucky minority, the Biden tax plan will burn you.
So when you said 67, that was one of the episodes that I listed in my notes. So I did know. You know what? We'll get to it, but it's in my notes for a different reason.
The cat's out of the bag, Aaron. But
okay,
do you want to lead with that?
Sure. So I listed. I think I actually listed 6 on accident. I meant to, and I don't know if I can cut one. So I'll end up giving 6. Maybe it's like this is the bonus one. The other 5 will be tracking. When it comes to a lot of our like when we discuss the tax episodes, and every time we talk about it, it's almost impossible to remove the politics side from it. And that's been a big theme of our conversations when it comes to kind of tax. Like there's income tax versus and that really affects income earners instead of wealth owners. And again, it's really hard to separate the political side of that. And I don't really enjoy the political conversations as much. And this was just an example of I'm proud of the episode in part because we'd done enough we had read enough other research. We had other people did the heavy lifting in terms of reading through the tax plan, but trying to get down to it. But it was that perfect example of the lucky minority that the Biden tax plan will burn you is the top 1% of income earners. So many things in that plan were targeting the top 1% of income earners, but not much was targeting the top 1% of wealth owners. And that episode was kind of the perfect encapsulation of that theme throughout many of our conversations. That I haven't really enjoyed the political side, but it's hard to remove that, especially when you come to tax conversations, which is important to us and our clients. And that consistent theme that you've helped me understand of if you're a business owner or an asset owner, the taxes work much, much better. It comes out to things like retirement plans, things you can deduct. But if you're an income earner, even if you have a really high income, the tax systems really works against you. So that's why it's on my list. Is just it was worth that conversation. And I also remember when we were first kind of discussing the title, I think you had suggested if you were in this unlucky minority, the Biden tax plan will burn you because it's only affecting 1%. It's like, well, no, that's actually the lucky minority that the Biden tax plan will burn you. It's just that quick conversation of like, no, it's the complete opposite of what you wrote. Because I usually don't change your titles, but that was the other reason why it sticks in my mind was the lucky minority phrase.
Right. Yeah, that is a good episode for that reason. And it did stick out to me that that theme is something that I did enjoy bringing to light with you, and frankly, uncovering it for myself as we were having the conversation. It's something that really stuck out to me in another not follow up, but later conversation where we really got to hone in on that particular concern. And that was the episode 86, the ProPublica one, where we said, how does your true tax rate compare with the wealthiest Americans? And it really kind of opened my eyes to what seems like a really core central issue when it comes to inequality that seems to get lost in the discussions, because there's so many competing concerns when you think about inequality when it comes to finances and wealth and income. But it really kind of put a spotlight on where the true concern lies. So 86 was one where it kind of had a mind shift for me, because in earlier conversations we talked about the notion of income inequality, and the idea that, yeah, income inequality is a thing. It's an issue. We highlighted tons of stats saying, hey, it's gotten worse. If you're the medium income earner in the US, you're not doing too much better. You're likely doing worse. And if you're below the median, you're definitely doing worse. And if you're the higher you up away from the median, the top 1%, 0.1, and so on, the more exponentially better you're doing. But all of this is kind of like pittance when you look at the wealth inequality issue. And especially when you tie that back to taxes, that's kind of what we unveiled in this episode. The notion is, when you look at this notion of a true tax rate, what your tax is that you end up paying as a function of your growth and wealth, it's kind of mind-boggling, the differential you see between an income earner versus somebody who's wealthy. Some of the numbers that we displayed in that conversation was that if you're an income earner and you want to grow your wealth by $1,000, you'll likely end up paying over $1,000 in taxes. And if you're wealthy, there's various ways that the system is set up so that you can increase your wealth by $1,000 and pay far less than $1,000. You can pay far less than $1.
Yeah.
It's orders of magnitude difference.
I think that's even one of the conclusions. Like, we just need to, but collective society just need more awareness on the difference in scale between income inequality and wealth inequality. But like you said, it's a comma difference. It's kind of, we're not talking about going from someone earning 500,000 to someone earning $1 million. We're talking about like wealth of 50,000 to 500 million kind of scale. Or even if you get the wealth up to 500,000, 5 million, it's still like you'll see these kind of top billionaires, their wealth can grow by 5 million multiple times over in the same year. And some of these some of the top are seeing their wealth grow on the scale of billions per year, and they might be paying taxes on $1 million per year. So that's what I say. It's not, like you said, it's pittance. It's truly it's not just a 0 or 2. This is like 3-4 zeros and a comma difference in terms of how the wealth can grow versus how the taxes get paid on the income.
Yeah. And the notion is, all of these income tax solutions mean nothing to this particular problem. Meaning you can tax income at 100% even for the people in this demographic, and it'll make zero difference.
Yeah. Okay, so was that on your list? Was that number 86 you said?
Yeah, 86 is on my list.
Okay. Any other stats that you want to go over before we get into the other episodes on our list?
Okay, so at a high level, we mentioned we're coming in on 6,000. But frankly, the monthly listens have risen. I think in the first year, maybe between 100 or so episodes a month was a good average, and now we're probably averaging close to 500 a month.
Oh, okay. That is a pleasant surprise. I guess I remember at the beginning, it's like getting double digits was, okay, this is a successful episode.
Yeah. So, that is certainly a good change and shift. And then, just some other stats here. According to the podcast predictor, our average episode is predicted today to get about 200 listens. I don't know how they come up with that number, by the way.
Yeah. Yeah, I have no idea either. I remember, yeah, it's probably some algorithm of just new, like unique listeners who will download new episodes in the past, kind of thing. And there's some
Yeah, they must
percentage of that.
be extrapolating the data somehow to figure
Yeah.
that out. But they're trying to factor in future listens on current episodes that are out there and then come up with a rough estimate.
Okay.
So for whatever it's worth, maybe 100 to 200 people might be tuning in.
Okay. It has been, I think I guess the like individual feedback I get. Maybe this goes back to that thought of like, is the podcast successful kind of thing? Because by numbers, like that's actually more than I expected. And so like, okay, if we had gone back 2 years and say this is what you'll get to, it's like, oh wow, that's amazing. But having clients mention that, oh, I was listening to this one episode of yours, you know what? It almost feels like an affirmation of the relationship I have with clients. That they genuinely appreciate the advice and the conversations. And I think a lot of advisors go through this kind of back of your mind, self-conscious. Am I doing as much as I can for my clients? Am I living up to their expectations? And when I hear a client mention that they're listening to an episode, which again, they wouldn't have to hire me to do that, or they could just ask me the question via email and I would take the time to answer because they're a client and they're paying me. But they choose to spend their like podcast listening time listening to other thoughts and ideas that I've had and conversations I've had with you. That I do get that kind of affirmation of, you know what, I think I'm doing a pretty good job. That tends to be what I get more so than hearing the stats and numbers.
Yeah, I do appreciate the feedback that we get, and I think even with that, it still feels like there's this cathartic benefit of just doing it that even on its own, pays
Totally
dividends.
agree. I totally agree with that. That is a great point. Even if the clients didn't mention it, and even if the numbers weren't that high, I would still like having this conversation with you. That's a really, really good point.
So some other stats in terms of our geography, we mentioned last year that we were in all 6 continents, or we're not in Antarctica, but we're working on it. But we are in 63 different countries and territories at this point.
Oh wow, that is pretty impressive. Especially because so much of what you and I discuss is like U.S. finance specific. Like I have a couple clients who they own property in India, and I have told them right up front, it's like, we can count that as an asset, especially if you're planning on selling in the future. We can kind of include that in the planning, but I can't really help you with that. Like, I don't know anything about personal finance in India and how to sell assets and or bring money over to the US. And so it's like, I've made it very clear just like how little I know about that and how I just can't help with that. So to hear that there's 63 countries that are still listening in, that is pretty interesting. Do you have any guesses as to what they could be listening for?
Well, I think there is some general insights that we bring to the table when it comes to just what makes sense from a financial planning perspective and investment perspective. As far as anything more specific, no.
You know what?
In terms of the data.
Now that I think about it, I wonder how many of those different countries listen to the crypto episode, which happens to be our most popular.
When you said I wonder, I'm like, wait, the crypto one.
Yep. Because that again, that would be the one thing that really would be not U.S. specific. So we'll just guess that there's a correlation between the number of countries and those different countries listening to that specific episode.
Right. And for whatever it's worth, we have about 769 different cities in terms of listens. So potentially 769 individuals have heard about us.
Okay. So that's interesting. So it's not like a 200 or 300 truly regular, but at least that many different individuals. Okay, that's interesting. That's also higher than I would have expected.
Yeah, and again, it's hard to say. Well, maybe not. Okay, so in the last episode alone, for example, it's 21 cities, and that was released a couple days ago. 27, okay. Sorry. Over the last 10 episodes, it's 173 cities.
Okay.
So, maybe that's more representative, maybe, in terms of people who are recently listening.
Okay.
Comes back to that like 200 number, 220.
Yeah.
Listens,
try
right?
and predict that. Okay. That's nice. Okay. I am pleasantly surprised by all those numbers. Thank you.
Yeah, good stuff.
Okay, so anything else before we go over the episodes that we had noted down?
Well, just one last thing in terms of what are people using to listen. It's still Apple Podcasts, number one. So 25% of our listeners are through that. And then 14% are through some sort of web browser, meaning they click on the link. And then, you have it on your website. I have it on my website. So that's probably contributing to those. And then in third place, 12% is the actual mymoneyspectrum.com.
Okay. Oh, you know what? Quick short story for you. I haven't actually told you this. I went to XYPN Live, the conference for the XY Planet Network, is in Denver, and I was walking through the different vendors, and there was one gentleman. I was talking to someone else at his company because of what the work they do, and he mentioned like, "You look familiar," and I said the same thing. You look familiar as well. I couldn't quite place it, and it took us. He figured it out, but it took a good minute or two to realize it was the other gentleman who has the podcast that when XY Radio interviewed us about our podcast, he was the third guest also being interviewed.
Ah.
So we actually finally met him in person after doing that one XY Radio guest about podcasting, that one episode.
That's very neat.
So I'm almost curious, like, what are the stats of that episode?
Yeah, I don't know. That was Michael Reynolds, right?
Yes. Perfect. Yeah, exactly. So it was like very surreal. Like, we've had a fairly in-depth conversation, and I barely recognized him because it was only once, and it was over Zoom, and it was about podcasting. So,
That's
yeah,
really neat.
it was a fun little story that I wanted to share with you.
Good stuff.
Okay, anything else from
Well,
our stats?
I think that's the big picture. I frankly, what I like to think in terms of the stats and stats in general is I'm not a person who kind of follows them on a day by day or week by week or month by month, but it's just nice to reflect every now and then and just see a little bit of validation that things are going as one might expect.
So it feels like we should check podcast stats about as often as clients check their statements.
I like that.
That not too often, definitely not monthly, probably not even quarterly, maybe once or twice a year-ish.
Yeah, it's one of those things where I'm not a big, like KPI person who follows all these little things to see how things are going. But I like to reflect every now and then and say, hey, my business has doubled in the last X
Yeah.
amount of, whatever. So
I remember when I first joined XY, one of the mastermind groups or like the startup group that they had of teaching you how to run a business. Someone mentioned KPI. I had no idea what they're talking about. It's just at no point in my career have I ever needed a key performance indicator. And then I learned about it, it's like, I don't want to track all these like little things. I just want to do the
right.
work that I want to do.
Yeah, it's the whole, if you build it, they will come mentality.
Yeah. I think that's going back to like uh whatever you decide to track is what gets managed, optimized, and grows kind of thing.
Hmm.
Um and so like there is good results on like bigger sales firms that if they're tracking these KPIs that will lead to other success. So if you and I were trying to grow bigger firms, then we probably should be doing some kind of KPI tracking.
Right. Yeah.
Okay, so when I put down when I went through the list of episodes, I realized so one I double checked 52 of our 1 year anniversary, and noticed that was really big on kind of themes, on like the really important ones. And as it's going through this, none of those. There's a few that kind of stood out, but my list ends up being kind of what was more memorable to me, and it didn't always have anything to do with the topic. And my first thing on my list is that example. Um, it's episode number 2. Are you overlooking the stellar asset class? And it reminded me of uh, I think our buying stocks for fun episode, which was really early. I think first 5, and I remember kind of making the comment like, no one buys bonds for fun. And I looked up the quick stats, and I think the total bond market in the U.S. is like 46 trillion, and the total stock market value is 49 trillion. And I have no idea those numbers are accurate. I just did a quick Google search just for reference, but it's honestly like bonds are really, really important to any client portfolio. Like really important, especially as we go through different kind of stock volatility. You get reminders of why you have bonds. It's not trying to improve return of a portfolio. It's that diversification, stability, and downside protection. But the reason I really noted this is when we could do the podcast production. So Trishul does the audio editing. I'll take care of actually uploading it. So I forget where I read this a long time ago, but anytime you have a blog post, you need to have a picture. It almost doesn't matter what the picture is, but you need to have a picture. And people like just the human brain, mind, and eye works a little better when it has a picture. And so we needed a picture for the podcast. Trishul found something. We need a picture for each individual episode. And so I try and find a quick search. And when I was looking at if we're talking about bonds, how do you give like a good picture that has anything to do with bonds? And we're like, it doesn't really matter what the picture is. So for that picture, I just found a little, I think it's like a paint on a sidewalk or on a street that says 007. And I still chuckle at that when I see 007 for the episode we talk about bonds. Every time. And I just wanted to point that out and share that, both with you. I mentioned a few others, but I mentioned you in the past. Every time I see that, I chuckle to myself. It's like, bonds is important, but the 007 little joke makes me happy.
Well, there's value to be had all over the place from our episodes. Even if it is just the image or picture associated with the episode.
So I'm really curious if anyone has ever noticed that without me having to point it out. I would love to hear that. But even if no one actually has noticed it, it's just my own little joke. That's still good enough for me.
Does that count as a dad joke?
Oh, definitely. Oh, yes. It's the financial advisor, business owner, podcast version of a dad joke, but it's definitely a dad joke.
Right.
Okay. So what was on your list?
Okay. So the next one on my list, these are actually in order of most recent to least recent.
That was in general how I ordered them as well. So that was episode number 2. So I did kind of most recent to oldest, but then you made me talk about 67, so it threw off that. But yes, in general, I also went most recent to oldest.
Okay, so yours was 82. Are
Yep.
you overlooking this stellar asset class? And my one here was, my first was 86. How does your true tax rate compare with the wealthiest Americans? But the next one on the list, number 2 for me, is 72. How many people actually beat the market? And again, I think this was one of those cathartic episodes where I feel like there's this understanding or this conception that everybody's beating the market, or tons of people are playing and many people are winning, and it's one of those things where if you're not on the right train, you're missing out, and the right train is trying to beat the market. So I think this is just one of those, again, ability to just put my best thinking out there that's quite different from what you likely hear from many other sources that are perhaps louder and more numerous.
So do you want to kind of, I think you can, how quickly, in as few words as possible, you summarize that episode?
Okay, so the answer to the question of the title is not many, or very close to 0% of people. Conservatively, probably 1%, using our fake gorilla math.
Okay. Wait, I've never heard of gorilla math.
It's just made up math.
I've heard of like back of the envelope math, but I've never heard of gorilla math.
I can coin a phrase as well, so we can.
Okay, well, that's now gonna be one of my like super inside joke goals, is to bring that up again at some point in the future.
Right. So the high level is there's this misconception that a lot of people are beating the market, but what it likely comes down to is you're not seeing the full picture. Meaning you may just be hearing about somebody's lucky trade, or the fact that they put something to work a long time ago and that happened to work out. But if you factor in everything, the wins, the losses, the averages, the money sitting on the sideline that you wanted to put to work, but you were too nervous to put to work, when you do a full accounting of everything, just like professional managers do when they have to report performance, it's likely that almost nobody is beating the market over their lifetime. They might be doing it for a small stretch, but to be able to pull it off over a period of 10, 20, 30 years, when you look at professional managers, it's just something that doesn't happen. And when you look at individuals, the stats are just as grim.
That reminds me, like, you see online all the time, this person predicted Tesla at 100. See what their next pick is.
Right.
I feel like I see that online ad a lot. But yeah, it's the difference between sustained outperformance and luck is probably most of the explanation.
Mm-hmm. Right.
Okay, so the next episode I had on my list was number 77. What's the real limit on 401k contributions? It's much higher than you think. And here we were talking about the mega backdoor Roth strategy, the mega backdoor Roth 401k, where you can make non-deductible after-tax contributions to a traditional 401k. Then, if the plan allows it, do Roth in-plan conversions. And in 2021, you could contribute up to $58,000 to a Roth 401k between regular Roth contributions and the after-tax contributions with Roth in-plan conversion. And it's not honestly a new strategy. I know Michael Kitces has actually written about it a few years ago. More and more companies have been offering it, and it felt like this is one of those, like, doesn't have to do with the strategy, but just as it's becoming popular, like more and more company plans are offering this, more advisors are looking out for this as a really good planning opportunity. The Biden tax plan, or one of the versions, said, okay, we're no longer going to allow Roth conversions of after-tax dollars, whether it's Roth IRA or Roth 401k, which basically killed the mega backdoor Roth 401k and killed the other smaller regular backdoor Roth IRA. And then the next version of the plan came out. Okay, the provision that prevented after-tax Roth conversions of after-tax dollars is now out. So the mega backdoor Roth 401k is back in as a viable strategy. And that's where we are right now. But it was just one of those things, like, that combination of, this is a really important strategy, but tax laws are changing, trying to make predictions based on proposals, waiting until a tax plan is actually passed. All of this kind of came to fruition. This was a really good example of that. Of, here's a good idea. Wait, we can't do it. Wait, we can do it again. Wait, well, I mean, let's not jump the gun the third or fourth time. Let's wait to actually see what gets passed. But having conversations, like, I remember within the span of 2 months, a few conversations with clients, like, okay, you should do this, max out for 2021. Okay, but next year we won't be able to. And our next meeting, okay, we think we might be able to do that back in again. Sometimes it's a little frustrating of trying to plan around this and having to change plans so frequently. But I couldn't ignore it because this was really, really important to some of the strategies, and so I had to really pay attention. And this episode was just the kind of the one that reminded me of that back and forth and that intersection between planning and taxes and politics.
Right. So. Yeah, and these 1,000-page tax plans certainly do keep advisors busy.
Yes.
So if they do nothing else, they do help employment.
And that's like, there's value in people like Jeff Levine, who summarizes the 1,000-page tax plan into a 2,000-word article on the website, where, yes, it saves me a lot of, like, the really heavy work to only moderately heavy work.
Right. And, just my little soapbox comment from that episode was that the government could make this all simpler and just give everybody the ability to contribute at some set maximum amount into their individual account, rather than having to be handcuffed to an employer's plan.
I still don't know. Like, I know the history of why that came to be, because I know it had to do with World War II. During World War II, with so many males fighting the war, the government passed restrictions on increasing salaries to kind of poach employees of the male workers who weren't at war. And so they said you can't just arbitrarily increase the salary to poach them, but you can the laws did allow you to offer benefits. So that's where like employer sponsored health insurance started to come from, things like retirement plans and pensions. So I kind of know the history, but I don't know why it's still the case. Like that, it feels like a really easy fix.
Right. Yeah. I don't know. I mean, I don't have enough tinfoil for my hat to speculate, but it could be fixed, but I don't see it being fixed. And it wasn't even up for discussion this time around. So,
yeah,
who knows?
Okay, so what's your next episode on your list from the last year?
Okay, so number 3 on my list is episode 61. The market's at an all-time high again. Now what? And it's one of those things that I think is just going to be relevant from now in perpetuity.
Do you happen to have a date of that episode?
Yeah, it's February 9th, 2021, which, frankly, we can do a quick check to see.
That's what I'm doing right now.
Okay.
So February 9th, the S&P 500 was at 3888, and it's up to 4690.
Right.
So
right.
It's not quite a 25% gain, but pretty close.
You can't complain, or you probably shouldn't if you are. Yeah, 25% in less than a year is something that you can write home about.
Yeah, it's a 20% gain in 9 months or 10 months.
Yeah.
So yes, what was that episode about? The market's at all-time highs.
The notion is whenever the market gets towards a high, which frankly happens all the time.
Yeah.
There's always the jitter of, hey, we don't want to put money to work now. Now can't be the best time. We're at an all-time high. Can't we wait for it to come back a bit? There's always this fear, and kind of the notion that with that line of thinking is frankly there's never a good time at that point, because it's either at a high, or if things do get shaky and get rumbly, well then that's not a good time either, because what if it goes lower? If things are really bad, now you're trying to predict the bottom, which is probably the hardest fool's errand out there.
Yeah, I even think just we got lucky in terms of the timing of that episode, where the following 10 months almost perfectly reinforced the message. And like you even saw, like, so I'm pulling up a chart of the S&P 500 from February, like there was a small drawdown. So it got down to went down from like 3888 to like 3700 or so a month later, 3 weeks later. And then so it keeps bouncing up and down, but the trend over 10 months was so much growth that we got lucky in terms of time, but we saw the exact thing we said was a realistic possibility at that time.
Yeah, and without the dip that happened in 2020, we would be still in the longest running bull market in all history, basically.
Yeah.
So even back in my hedge fund days, 2014 through 17-ish, 18-ish, we had that same story of, the market's at an all-time high. Let's be afraid,
Yeah.
Let's run for the hills. And we're almost, 8 years on from that point. And that was 8 years on from when, that we were at a low. So how long can this keep going? I don't know. But trying to predict when the market's going to top out, way too hard. And if you mess up, it's likely that your future investments, you'll have to perform so well, not even the best money manager on the market can make up that dip.
Yeah.
That missed opportunity.
So I think that was part of the message was, if you're buying stocks or any kind of equities, you have to be thinking 10 years anyways. And at that point, if it does drop the day after you put money in, but you're thinking 10 years, like that on the terms of like the time frame and the scale, it just comes out as noise. And so from your example, that March 2020 big drop that kind of interrupted the biggest bull market. Let's say you invested middle of February, and you put all your money in right before that big drop, and so you feel like you got the worst possible example of you put your money in and you watched it drop. What was it, 20% at that time? 15? Do you remember kind of that short peak to trough by any chance?
So the peak to when we started discussing it was about 15%, but I believe it went down at least another 10% from there. So call it 25. Yeah.
So if you put it in right before the drop and saw a 20+% decrease in your value, if you did nothing and just held on, you're now at like a 40% gain. You still average 20% per year from February 2020 to now. Again, I'm oversimplifying because that's just US large cap, and if you're working with an advisor, you'll have some international and emerging markets and small cap, and those have not quite been as powerful as US large cap, but the message still remains the same.
Yeah. You know, the 2 cents on the 2008 is, if you had invested the weekend before Lehman went under, you know, basically before all hell broke loose in the markets, you know, the worst time to possibly put money to work, because that following Monday, Lehman went under and everything just started to collapse like dominoes. If you had done that and held on for 10 years, you would have averaged over 10% a year, which is an amazing return.
Yeah.
Even though you would have been really kicking yourself for the following, you know, X amount of months.
Mm-hmm. So, September 2007, the S&P 500 was at 1,500. Dropped all the way down to 700. So that was that roughly 50% drop in the market or so. And that was peak to trough. I think it was like 53-ish. For the year 2008, wasn't it was a negative 40-ish, negative 45. But peak to trough, if you happen to pick the worst timing, you would have had a negative 55-ish% in large cap. And so even after accounting for that drop, you've tripled your money just by leaving invested over the following 14 years. So yeah, it's, again, if you're investing in stocks because you want that upside, you're thinking long term anyways, and that short term noise just doesn't phase you. It doesn't phase your money. Like you'll have those feelings, but it doesn't impact your long term returns.
Right.
Okay, so next one on my list was episode 74, and here it was we kind of talked about the psychological benefits of financial independence, and where there's definitely value in kind of the FIRE community and pursuing financial independence, but you didn't have to retire early. And it's trying to separate the financial independence benefits from the retire early part of that, and you can get a lot of those same benefits of just like leverage and work. Like you don't need to put up with things you don't want to do if you're financially independent. If work is optional, you now only take on projects and companies and roles that you like, that you find engaging. And these are kind of all the same things if you are working with an advisor, who've done the work, and that you know that you're on track, where you don't have to deal with the stressors, even if you're not financially independent at this point. But if you know you're on track to be financially independent when you want to, you also get some of the same psychological benefits from being financially independent. And that's come up for me in a lot of conversations with clients where sometimes they will, if they've had company stock and sometimes they are financially independent, they might still keep working. And I kind of ask them, make sure you're working for the right reasons kind of conversation, not just because that's what you've been doing the last 3 years. Others that they might feel they want to get out, but they can't until their company stock gets to a certain level. It's usually the flip side. It's like, no, we can make this work and we'll figure this out. And as long as you keep saving, you'll be financially independent. But this time, you don't have to stay at this one job that creates stress and adds stress to your life. And so I liked that conversation of separating out the benefits of financial independence from retire early. And there are even times we can get the benefits without the financial independence. So I don't know if you remember anything from that conversation of FI versus RE.
Yeah, that was my high level takeaway from that conversation as well. And frankly, it does make sense to me when it comes to financial independence, retire early. I think the FI part is really where the money is. It's the notion that once you're financially independent, you can retire early or not, or basically you get to do what you want. So it's basically financial independence, do what you want, or bid what you want. Doesn't quite roll off the tongue.
I was even it just rolls off the tongue. Like the same little idiom there. Okay, so what's next on your list?
Okay, so number 4 on my list is episode 60. What's the best way to beat Bitcoin madness? We uncover the facts that nobody told you. And, frankly, even the other Bitcoin episode, which was our number 1, the one that came out recently, that could have easily been in place of this one. So, whatever I said when we first talked about that episode, 97, was it? Our number 1 episode, in terms of listens, it holds here. And it just gave, or it allowed me the ability to just give my opinion on a topic that's out there that's talked about a bunch, and where I feel like my opinion is kind of against the grain. So I felt it was important to have my say. So that's why I made my list.
So do you own any Bitcoin right now?
Yeah, so as I mentioned on that episode, maybe tangentially through some of the companies that I own, but not directly from me to a Bitcoin holding now.
So every now and then, if I have a conversation with someone, I have this like kind of like I think it was Bank of America in 2008. I remember just seeing that price get ridiculously low. This is, again, not an investment philosophy, not investment advice. I'm not trying to pick anything, but I have this feeling like if Bitcoin got down to like 10,000, there's like it's such a huge drop that like really everyone who is believer like, no, this is going to fail. I feel like that point I might be interested in getting in. And if it ever happens, then and I miss out, I'm okay with that. It's not going to phase me at all. But so, like it's one of those things like I think the odds that this is around to stay is more likely, but I'm not getting in just because it has gone up. But if it goes down a lot, and I mean dramatically, then maybe I may be interested. So I may never own Bitcoin, but that's the example of how I could get there. Maybe. So don't take that advice of trying to pick a Bitcoin price, but it's there's no reason why it can't go down that much. There's no underlying value that says it has to be at 50 or 60 or 40,000. It could go down just as much as it has gone up. I think that's probably the best way to phrase it. It has gone up so much, it can go down just as much. There's no reason why it can't.
Right.
So.
Yeah. And that's different, or it's not completely the same as a business, where a business has actual assets
Has revenues, has
that are generating income.
yeah,
Yeah.
yeah,
Like, even if it's intellectual property, the valuation of that business is likely tied back to an income driving source.
yeah. Okay. Uh, second to last episode on my list was at number 73, where we talk about direct indexing. And this is almost the complete opposite of talking about Bitcoin in terms of I genuinely feel this is the future of investing. That this is the combination of passive, low cost, with the technology that allows you to own individual stocks for optimal tax loss harvesting. And I don't think we talked about it as much in that episode, but also uh, ESG purposes, environmental, social governance purposes, where you can choose to exclude or emphasize stocks that and companies that fit your personal beliefs on society in the future. So it would not surprise me if that becomes a bigger part. But direct indexing is now, especially, I know a few providers went for large cap and international developed. They can do it at more or less the same costs as like a Betterment or Wealthfront. There's still some scale, so I think the minimums they have are on the scale of $100,000. So it's not quite down as cheap as Betterment Wealthfront, but I think it's going to get there probably within the next 2 to 5 years. And kind of the next level is adding the ability to buy fractional shares of individual stocks. So, because I already know that's possible with some things and some custodians, so I can see it getting there with individual stocks as well. But this is one where I think I convinced you that the theory lined up really well with the potential. That everything was kind of theoretically sound, and uh, the downside is your statements get big, but people don't really want paper statements anyways, and so if you're looking at your statements online, that's an easy thing to handle. So this is one thing I've been uh not exactly quite pounding the table, but I'm a strong believer that direct indexing, the ability to own individual stocks at a passive, low cost asset allocation is really gonna be the future, and it'll expand to other asset classes. It'll expand to fractional shares, which bring down minimums. So this, I think, you're just going to see more and more of.
Yeah, I enjoyed that conversation because I agree with your sentiment, and in fact, having that conversation from you did shift my mind from, kind of believing in the idea in principle to kind of believing in the idea in practice. Just to see how far things have come, and to understand that, yeah, it does seem like over the next few years, this is going to be a pretty transformative transition that we'll see in the investment management space, where I'm already seeing a lot of other brokers kind of jump on the on the wagon to try to offer these types of solutions. And more competition is only going to mean more value, a drive to zero in terms of costs.
Mm-hmm.
So I think it's all good for this type of thing. One thing right now is these solutions are, I think, mainly targeted to U.S. stocks, probably large cap, but that could even expand towards a more diversified portfolio. But one step at a time, and I think all the little pieces are in place for this change to kind of make its way through.
Yeah, it's like an example. You can now buy ETFs for any single country that has publicly traded stocks. So if you wanted a China ETF or an India ETF or a Japan ETF, those are available. This is more of a guess, but I'm gonna say on the scale of 5 years, you can have a direct indexing strategy that you can customize to fit kind of whatever you want. You can match the index of England or of kind of the Eurozone, or uh, looking at just the BRIC countries and other emerging markets. Like you'll be able to be that customizable, and the technology will get there where, okay, here's your passive, low cost, 5 to 10 basis point strategy that will match the index of what you want. It excludes the companies that you don't like and will get market returns for you. So what is the last episode on your list?
Right. So the last one on my list is episode 59, and that's stock options are risky business. Here's when they can actually make sense. And the reason this made my list is because, again, it's just one of these episodes where I feel like the common narrative that I hear and the common themes that I hear from many sources just all over the place, I just don't agree with. And it just gave me the opportunity to say, here's what I think, and here's why I believe what I think, and it just doesn't really line up with what you likely hear when it comes to this space. And options is one of the place where it's a pretty complicated field, and there's a lot of nuances, and it can get incredibly complicated when you get down to the actual nuts and bolts of it. The math and all of that's involved. But to also be able to use it successfully, you got to know a good amount. So, frankly, I did enjoy the ability to just get that information out there, so that kind of said my piece.
It's I remember that one because it's so easy, and there's it's so easy to kind of say, here's a good solution for you, like this can help you figure it out. Like if you own company stock, you want to have a covered call strategy because you're not going to actually sell it, or like a trailing stop loss. Like if the stock starts to drop, you aren't going to see that individual stock drop a lot. It's like this comes up more often of like, here's a way to hedge, and as soon as you get, like, it starts out like, oh yes, that makes sense, I can see this working, can save me some money, and helps kind of like, I think you've had a lot of great insurance examples over the years, just kind of buying insurance on the investment. But you go like one or two steps further, and it gets so complex so fast, and you start like, oh, I can do calls, but I don't even need to own the stock to write calls. Like, and it's one of those things where I feel like the vast majority of people are just better off avoiding than wading into.
Yeah, in my mind, it's a scenario where everybody would love to take market risk and not experience the downside.
Yeah.
Or, everybody would love to speculate and get huge returns and minimal losses.
Mm-hmm.
But there's just the simple answer is there's just no free lunch. If you do a full accounting of what's involved, you'll end up in the red.
Yeah. So the last episode on my list was episode number 65, the most important financial advice for someone in their 20s. And realistically, it could apply to anyone, but I have seen so often, if you can just save more, things tend to work out down the road. Just saving more. And it's not just save, because I think that's one of the keys, is that you want to establish this habit of saving and increasing your savings over time. So that's why I say, from one year to the next, save more. The sub, so if that was like a heading or a bullet point, the sub bullet would be just invest in equities, probably. That's not always exactly the single most important advice for anyone. Cash can make sense for some people, depending on time frame. Sometimes having a mixture of stocks and bonds can make sense. But if you can, I see so many times where if you start saving early and you establish that behavior, whether it's cash or stocks, you look up a few years later and things are just that much better. Things will be better if you establish that behavior of saving more. And anytime we can systematize that or make it as easy as possible. So 401ks work really well for this. Just keep saving more into your 401k, keep saving more into your 401k. You look up a few years later, it's like, wow, that's the stock market must have done really well because my 401k is a lot bigger. It's like, well, actually, no, like 80 to 90% of the value of that 401k is just the amount that you put in. You got some stock market growth on top of that, but just the amount that you save makes a huge difference when you start doing it over more and more years and even starting to get into decades. And so every now and then I'll have a conversation with someone. They'll reach out about stock option question, and they don't make sense as a client. I try to give them advice answering their stock option question, but when they start talking about the situation, like, you know what, you're doing a good job. Just keep saving the $3,000 a month that you're saving based on your income and cash flow, and like do that for 2 years, and let's see if something happens to the stock, because it's a small startup. It's like, okay, the risk isn't worth it, but just hold on to the options, but just keep saving more. You're doing a great job. Keep saving more, max out your 401k, keep investing. And those that are able to do that, things might get complicated down the road when they go to look to hire an advisor. But once you kind of clean things up, they're always in a better position than they realize. I think that's probably one of those that have really good savings habits, when they look up and see what they have 10 years down the road, they're always in a better position than they realize. And so that's kind of, it fit with the theme of, I can't believe the podcast has done so well. And so like I look up 2 years later, it's like, wow, that's a lot more listeners and episodes and topics and than I realized. And it's the same idea of that applies to personal finance. Just start a little bit, do this much this month, do the same thing next month, next year increase it, save a little bit more, and you look up and it's really hard to feel in the moment the benefits of compound growth. It does take years to notice that. And this was just the perfect encapsulation of that just fundamental idea, because it wasn't just personal finance. It applies to almost anything. If you can do one push-up and then the next day you do 2 push-ups, the next day you do 3 push-ups, that compounds really fast. But do you have any other final thoughts for us today, Trishul?
Well, good stuff, Aaron. And like I've said over this conversation, and hopefully others as well, I do enjoy them, and I do enjoy the fact that we get the ability to put our best thinking out. One thing we should probably mention is that we are going to every other week going forward, so that is going to be a change for us. So, and the reason for that is you can imagine we're getting more busy, and there's more of a time constraint on our end, but we still want to have the ability to put out quality episodes. So switching from a weekly to every other week format, we think will make more sense in terms of keeping the quality where we want for these episodes, being able to bring deep insights that we are able to think about and provide feedback on and discuss in depth, while also still, being responsible to our other outside of podcast activities.
Yeah, it's the clients who hire us. They're honestly our first priority when it comes to the business. They are much more important to me than the podcast listeners. I do appreciate, especially the numbers are much more than I thought, but uh, I I need to make sure that I am serving my clients as well as they expect. And I think this is one of those just intentional decisions that we talk about, that, like you said, I don't want to give this up. This is really important to me, but this does have to be a lower priority than the clients who have hired me.
Well, that all makes sense. And again, still love the episodes, love talking to you, Aaron, and, enjoyed this one as well.
I really did as well. And so I'd love to hear from our listeners if there's another episode they thought was their favorite that they want to let us know, and I'm curious. I want to know like how many people would say, "Oh, the crypto episode was my favorite." But if there's something that an episode we didn't mention that you really liked, we'd love to hear that.
Good stuff. Well, thanks, Aaron, and thanks everybody for listening. If you're enjoying these conversations, do spread the word or subscribe to the podcast. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.